Welcome to the Economy magazine at I-24 News, where we take a look at the world markets and the global economy. I'm Natalie Ehrlich. Well, coming up today on today's show, almost all about the Fed, as Janet Yellen is widely anticipated to raise the interest rate. We take a look, an in-depth look at what that means for the U.S., Israel, and the global economies. And we also get a chance to speak with New York-based financial markets expert Ron Insana, and then Neve Ellis of the Jerusalem Post joins us in studio for all the answers. Well, on to the financial headlines. Asian markets mostly rising higher Wednesday ahead of the crucial Fed decision today. Japan's Nikkei making strong gains of 2.61%, the Hang Seng up just over 2%, and the Shanghai Composite up 0.17%. European equities also making gains. By the afternoon, London's FTSE, Germany's DAX, and France's CAC all up almost 1%. Well, U.S. markets also signaled a positive open. Oil futures slipped further into the red, with Brent crude falling almost 2% on the day. The Greek parliament approved a bill enacting economic reforms in exchange for €1 billion of bailout funds, drawing protests in response. Prime Minister Alexis Tsipras' left-wing government agreed now to enact changes in the public and in exchange for the new round of EU funding. Members of the communist-affiliated labor union waved flags and then held up a banner reading, quote, "End your illusions," outside the parliament. Well, the bill also drew condemnation from Tsipras' left flank, as lawmakers accused him of abandoning his social justice principles.
The economy sank because of the experiments you conducted in your first term, where we saw more than 40 billion euros in deposits vanish and capital controls imposed. That's why we had to proceed to a bank recapitalization that had previously been unnecessary, and it was forced upon you under the worst possible terms so that the remaining savings of the Greeks could be salvaged.
Argentina declared a national emergency in the country's electrical energy sector, even as the country's state-run energy firm announced a $500 million joint venture with Dow Chemical to drill for nat gas next year. The new government announced measures to ration electricity and added that the state of emergency will likely be in place until 2017. According to official statistics, demand on the country's electrical grid was close to reaching capacity. Energy and Mining Minister Juan José Aranjuran said that the relations were in place now to avoid a meltdown in the system.
The president of the nation, Mauricio Macri, has raised an emergency decree on the national electricity system. We estimate that this emergency is going to last. Regarding the capacity to resolve the problem, we estimate it is going to last until 2017.
The World Trade Organization kicked off its first ministerial conference in Africa. Insiders say that the four-day Nairobi meeting will now focus on trying to nail down a partial deal focused on agricultural export competition and trade development in the world's poorest nations. The WTO also welcomes war-torn Afghanistan and Ebola-ravaged Liberia as inaugural members.
Africa is a continent of hope, of promise, and potential. And through fair trade rules, we will be able to lift millions of our citizens out of poverty.
Chinese President Xi Jinping on Wednesday called on members of the Shanghai Cooperation Organization to intensify cooperation in the fields of security and economic development. Speaking after the SCO meeting concluded in Chengdu, Xi touted the Silk Road Economic Zone and then pushed for greater collaboration with the Eurasian Economic Union. He also pushed for a better integration of the development strategies of all the member countries. Meanwhile, in Israel, the Histadrut called for a public sector strike over the issue of public sector wages. Histadrut chairman Avi Nissan-Korn declared a labor dispute on the issue on November 25th, but the finance ministry and the union have since been unable to reach an agreement. Hundreds of thousands of government workers are now set to stay home starting next Tuesday, shutting down public services, including schools, and limiting services in areas such as the social work and health. Well, now for insight on the largely expected rate hike decision, we are joined on the phone by New York-based financial markets expert Ron Insana. Thank you so much for joining us, Ron.
Thanks for having me, Natalie.
Well, tell us, how exactly will the Fed rate hike affect the U.S. economy?
Well, we're not quite sure. You know, the economy's been slowing down a bit in recent months, and people are somewhat nervous about quarter-point rate hike could slow things down further, given the weakness that we're seeing around the world. But the Fed largely believes that the economy domestically can withstand a quarter-point rate hike. The real question, I think, beyond today, assuming the Fed does go forward, is the pace of future rate hikes, the frequency with which they come, and the size of any future rate hikes. Those are all questions that will probably be answered in the news conference that Janet Yellen is holding this afternoon.
Well, what does this rate hike tell us, if anything, about the health of the U.S. economy?
Well, generally speaking, the U.S. economy is pretty stable. The consumer's been doing reasonably well. Housing has rebounded. Auto sales are at record levels. Where we're seeing pronounced weakness of late is in manufacturing, which seems to be a global issue. China's slowing down. Japan's still weak. Australia, Europe, all a little bit on the soft side. So that's a question, and we've never seen, by the way, the Fed raise interest rates when manufacturing was contracting in the United States. It's the first time we'll see that. So the question is, will the consumer and the strength of the consumer offset the weakness we're seeing in domestic and global manufacturing? And that may take us a little while to figure out.
Well, analysts already turning now to 2016. Do you have any predictions for the future Fed rate hikes? And is this the start of this potentially new trend?
Well, it might be. I tend to believe that the Fed's going to be pretty close to a one-and-done type of operation. The economists, generally speaking, believe the Fed will raise rates next year 3 or 4 times. I'm not sure that the global economy, emerging markets who have their currencies pegged to the dollar, China, which until recently has had its currency pegged to the dollar, can withstand those rate increases without causing global financial market turmoil. So I'm not sure that the Fed's going to go through a full tightening or normalization cycle. I would be inclined to think that they're going to do one and then wait for a number of months to see what the fallout is before they embark on anything further. And if the economy weakens, they're either going to have to leave rates where they are or maybe even cut them back to zero.
Well, thank you so much, as ever, for your analysis, Ron Insana from New York. Very much appreciate it. Moving on now, investors are eagerly awaiting this news on Wednesday and a likely rate increase by the U.S. Federal Reserve. Here are the details from Daniel Roth.
For the first time since 2006, the United States Federal Reserve is set to raise interest rates from the near 0% they've sat at. This would also be the first such move since the financial crisis began more than 7 years ago, during which the low rates supported recovery. The U.S. economy has been on a stable, though slight incline over the last few years, which has led the Fed to lay the groundwork for a rate increase, which will, according to most analysts, be a minor rise of up to 25 basis points.
We do think that the initial increase will be 0.25%, that it will be the first of a series. However, we are not expecting those increases to be consecutive, and we'd expect them to be very data dependent. As we look through 2016, our expectation would be that we'll see a further 3 tightenings during the course of the year, perhaps 4 if conditions warrant.
Though the expected change is not very big, it can impact everything from mortgages to business financing to savings accounts. The Fed's policy has been to ease into the decision, and the reason is clear. 2014 saw 20% gains in sectors such as real estate, but discussion of rate hikes led to a rougher go of it this year. And though it seems part of the Fed's game plan has been to keep markets as composed as possible and take this decision at a slow pace, there are those who think the economy is not ready for this kind of move, seeing the risk is too great.
I don't think there is a good reason for them to raise interest rates. I mean, first of all, even though the official unemployment rate is 5%, you have the economy's down about 3 million jobs from where it should be if you count all the people who have dropped out of the labor force or working part-time involuntarily. So we still have a very weak labor market, weak wage growth. And so raising interest rates will slow the economy if it has any impact at all. That's what it's going to do.
Meanwhile, as most traders think the Fed will raise rates 2 or 3 times in 2016, some say the Fed will most likely increase rates a few more times over the year. A Reuters poll of economists found that the expectation is for rates to rise between 1 and 1.25% next year and up to 2.25% in 2017.
And with us on set now for more analysis on the Fed is Neve Ellis of the Jerusalem Post. Thank you as ever for being with us.
Thanks for having me.
Well, it certainly looks like even this topic is generating controversy here. What can we expect for the U.S. economy?
Again, it's not exactly clear what's going to happen, right? It's always an element of surprise, but the vast expectation is that today we're going to see a rate increase for the first time in 9.5 years from the Federal Reserve. And, you know, this is controversial because on the one hand, we have things like low unemployment. The unemployment rate's at 5%. The economy's been growing consistently in the U.S., around 2.5% GDP growth. So these are exactly the kinds of signs that one would need in order to start increasing the interest rate. But on the other hand, there are also issues like inflation. Inflation is supposed to be around 2%. That's what the target is. And that's really the main focus of what the Federal Reserve interest rate is supposed to be. It's inflation and economic growth. In fact, inflation is much, much lower. One of the benchmarks that they use is at 0.2%, right, instead of 2%. So there are some people that are saying, look, this is premature. As we saw in the clip, you know, if you're not looking at the unemployment rate, the big number that we're used to hearing, the 5%, we're seeing that there are still a lot of people that are outside of the labor market altogether, right? People that aren't even looking for a job, so they're not counted in that figure. So there's controversy about whether this is the right thing to do. But since Yellen has been so vocal about sort of hinting and telegraphing that this is what the markets and people should expect, it's very difficult for them to go back because they're worried about their credibility. They want people to believe them when they speak.
Fascinating. But we even see people like Paul Krugman, who is a Nobel laureate in this field, advocating against this rate hike, advocating essentially that this is perhaps premature.
So I think that the one thing that's important is that it's going to be going up very little. The practical effect of that is very small, right? 0.25% difference in the interest rate at this point is not, you know, the deal breaker that's going to make or break the economy. What they're going to see is how the economy reacts to that, what the impact is, and the other thing that people in markets and investors are looking for is sort of what they telegraph is going to be happening in the future. Are they going to be trying to raise interest rates another 4 times next year, which is sort of what their last assessment insinuated? Or are they going to, you know, slow it down and say, you know, maybe next year we'll only raise interest rates twice? So, you know, they still have that flexibility that if they raise the rate today, you know, and they decide that maybe it was a little bit too soon, they can keep it at 0.25% for a while, and it doesn't mean that they're going to necessarily, you know, run into an economic disaster as a result.
Right, and in a sense, the global markets investors have been anticipating this rate hike for some time. They were supposed to do this as soon as September of this year, but then we saw that stock plunge in China, and then they retracted that decision and have postponed it until now, or what we believe will be now.
Right.
I mean, time is
Unless
yet to see
an upset, yes.
what happens. So perhaps this decision has already been priced into the markets.
Absolutely, and I think that unless you get some sort of real surprise that they do something much bigger, or again, you know, that they sort of show that they're committed to a series of increased rates in the next year, then you're not going to see a big reaction in the stock markets because this has been anticipated. And again, Yellen has been very much trying to do that. She's been saying expect the interest rate to go up. So this particular thing has been priced in. I think what we need to look for in the markets is sort of how the Fed issues its forward guidance, what it says is going to be happening in the future.
Right. People will be looking more at the language than at the decision itself. Now let's look at the ECB. Over there, they're adding a lot of stimulus to the market, and this is a huge discrepancy compared to where we see the U.S. going. Describe this. Why is this happening?
Right. Well, the main reason, of course, is that in Europe, the economy is still stagnating. In some places, it's still recessionary, and they're still doing their best to stimulate the market. You have to remember that, you know, the Federal Reserve acted very swiftly when it came to the crisis in 2008 and 2009, and it lowered the interest rate to 0, and it started quantitative easing, which was then considered, you know, really unconventional and sort of out there policy to really put more liquidity in the market and help the economy grow. Europe was really slow to catch on to this. And in fact, they even raised their interest rates back in 2011, only to have to lower them again because it was having an effect on the economy. So they've just started their quantitative easing program recently, and now they're ramping it up. And the reason is that they're just not in the same place. Unemployment there is almost double what it is in the United States, even more than that in some places. So they are still, you know, trying to contend with the economic growth part of it.
Interesting. Well, what about the global economy? What impact will this rate hike that we are expecting today to come out of that meeting from the Fed going to have on world economies?
So there are a couple of different aspects to this. First of all, it's going to mean that it's more worthwhile to invest in the United States, and we're expecting to see inflows go to the United States. Why? Because there's just going to be more of a return. The interest rate's going to be higher. But one of the worries that's out there is that, emerging markets, which are already suffering from these low commodity prices, they're used to selling commodities, they're suddenly cheap, and they're not having the money to fund their governments, that they are going to have trouble paying their debts. Increase in the rate means that the dollar is going to be stronger, and all these countries that have their debts in dollar denominations are suddenly going to find it more difficult. So that's one thing that is definitely going to be a concern. The other, of course, is that just other economies against a stronger dollar, are going to find the American market a little bit harder to access.
And just last word here, what is your final thought?
I think that we can definitely expect to see a rate rise today. I would be very surprised if they didn't. And, I think that the Fed has it in its best interest to keep markets quiet.
Well, thank you as ever for bringing this analysis to us on the Fed. And that wraps up our show today. Do stay tuned here every day for all your global economic coverage. I'm Natalie Ehrlich from the Jaffa Port. Thank you very much for watching.